It's an emergency alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's Bank of America's terrifying warning to its customers. They're saying your money may not be safe. I'm going to show you why Bank of America is making that claim, and more importantly, where they think you should be putting your money right now. Because this is our Sunday show, the show that makes you money, where we like to look at the technicals, momentum, and machine positioning of the broad equity, bond, currency, and commodity markets each and every Sunday to help you make more money trading and investing now. Let's head over to Bank of America's Global Research Department, headed up by none other than Michael Hartnett, one of the leading investment strategists in this country. With the flow show, he's saying 50 for the little guy, and he's talking about the 50 basis point rate cut that the Fed did last week. And this has incited people to rush in and buy stocks in such a panic because the broad belief that's been suggested by Wall Street is that rate cuts are bullish for stocks, and that if you have cash or you have bonds, you need to sell everything and put all your money in stocks because they're headed higher. And Hartnett says, well, wait a minute, not so fast. The last time the Fed eased 50 basis points with credit spreads this low was January of 1981, and with stocks at all-time highs was back in April of 1986. And keep in mind, it's not unusual for the Fed to start a cutting cycle with stocks near their all-time highs. This isn't a suggestion to take risk, but let's talk about why this is happening, because we're seeing a sharp drop in money market funds, and this is the source for the blow off top risk that is being cited here by Bank of America as investors pull money out of cash and buy stocks. And yet Hartnett warns, he says, look, this isn't the opportune time, because look at what's happened. When we go back and look at the federal funds rate, yes, there are times that rate cuts work out, but more often than not, when we go back to 1915, you can see all sorts of signs of Wall Street crash, policy mistakes. You see long-term capital management crisis show up, and everything you don't want is showing up when the Fed starts to cut, particularly 50 basis points, which is a sign that perhaps this isn't the bullish indicator. He goes on to say in 12 occasions since 1970 that the Fed cut rates for the first time. There's three types of cuts and three types of reactions. Well, soft cuts, which is considered a 25 basis point cut, means the Fed is cutting into a soft landing, which Hartnett says is 84.95 in 2019. This is positive for stocks. The S&P up 10% in the 6 months after the first cut. And this is what Wall Street is telling everyone. This is a soft landing. You don't want to mess out. You need to get in it to win it and buy big. But what if that's not how it plays out? Because if we have a hard landing and the Fed's forced into hard cuts, now you're looking at 73, 74, 80, 81, 89, 01, 07, and that's negative for stocks. Meaning the S&P is down 6% over the 3 months following. But we've noted the Bank of America's lead strategists have been bullish on bonds, saying yields go down, bond prices go up, and then there's panic crashes. This is when Wall Street has a credit event and the Fed reacts. It's happened in 87 to 98, and that means the S&P goes up. The risk right now is, what if we're headed into a hard landing? I'd love to know what you think. Do you think we're headed into a soft landing or hard landing? Weigh in the comments below. Love to hear your opinion, because the Fed 50 basis point cut sees Wall Street follow soft cuts or the panic cut script, and what you get here is a classic asset rally as everyone comes piling in. But this is on the expectation that the Fed can prevent payrolls from falling under 100,000, which, due to the rather large revisions and the inaccuracy of the payroll reports, may already be happening. We just don't know. And can it starve off the rise in delinquencies and defaults? The answer to that question is no. A 50 basis point cut isn't going to do anything for someone who's delinquent on their payments. But what this does is, if it does confirm a soft landing, the best plays are recessionary commodities. This is something we've been telling our subscribers about. Look at the commodity space. We've been seeing all kinds of hits on machine positioning and shifts in momentum. It's all stacking up in the commodity space. You want to be taking a look at those reports. Links are in the description below. We'll talk more about that later, but the focus focus here is if you want to make money, forget stocks. The odds are we may be headed into a hard landing because the probability suggests that. Now let's head over to Goldman and we look at their tactical flow of funds. Talk about the playbook for 2024 because there's 71 trading days left in the year and they're going to get traded different because this year, of course, we have an election year. We have an aggressive Fed rate cut, possibility of more rate cuts in November and December, which could suggest that we are indeed headed to a hard landing here. But let's talk about the corporate blackout window. This is going to run to October 25th. So mark your calendars on that. 55% of corporates are right now in their close period. They're not buying stocks, putting this next week at risk to see the equity market go down. But keep in mind, this was the second largest authorization in history. Will that repeat next year? Well, many people believe it will, but keep in mind, as we continue to see the broad economy run out of money, it's going to be harder and harder for corporations to stack up bigger buybacks than the year before. Watch for this number to come down, and this is going to be a big red flag during earnings season if companies cannot keep buying back their stock at such a feverish pace. But let's talk about the CTA flows from the machine positioning. If you don't know what a CTA is, they're just a black box trading large amounts of money. We're talking hundreds of billions of dollars being traded by these machines. When price of the market goes up, they buy. When it goes down, they sell. They don't look at any other indicators other than price and the direction it goes. But in a flat tape where the market is not moving at all, we see buying of 21 billion in global equities, 11 billion into the US. An up tape, you see this thing's going to max out 30 billion in global equities, 10 billion to the US. And in a down tape, there are going to be slight sellers here, but the risk is over the next month, if the market continue to go higher, you're going to see the final push, 74 billion into global equities, almost 10 billion into the US, and then it's game over because if there's a down tape, these things are going to turn and burn in a big way. And we've seen releveraging from vol control strategy, risk parity strategies. Everybody's levered back into equities. And now we're seeing retail investors pull money out of cash to chase this market higher because they're being told, look, 20 times the Fed's cut rates. A year later, you'd be up double digits. There's a reason everybody's racing in here, except the risk that we're facing a hard landing. But if you're looking to get back into the market, let me tell you when it maybe a better time will be because the year end is the best seasonal period of the year. That's right, the last 2 months of the year are the best performing months, bar none, especially if the market is higher headed into year end. And here's the best part. We see Goldman did a test. They looked back over elections, said it made no difference. No difference in election years. Last 2 months, usually the strongest. Why is that? Corporate share buybacks pushing all the way to the end of the year. So keep an eye on that. If you have money on the sidelines, maybe hold off and see how the market performs. But let's talk about what we see. Let's take a look at our screens here. We're going to start out with the S&P 500 as we do every week. Momentum has turned positive. How do we know that? Well, over the last 8 days, we've seen a shift on our Momentum Timer Pro. Now, maybe you like to trade the technicals. Well, we do that as well. The relative strength index, it's at 62. That means if it's over 40, momentum's positive. The moving average convergence divergence, or MACD, that's got a positive cross. Plus, we have a proprietary overlay that we run against all the technical signals. We run it on this report to confirm the buy signal. But we're seeing over a 6-month, 3-month, and 1-month window, momentum is stretched because we look at momentum over multiple time periods, including the daily here. Now, you'll note we don't have a position because we did get stopped out of this, and perhaps for good reason, because let's take a look at the charts here, and something that's showing up here is of rather concern. Because when you have a long trend up in equities, well, things eventually revert as more and more people and more money piles in. In fact, you go back here to the pandemic bottom, we're going back to March of 2020, you see a big rally here and a little bit of a pullback. You see that happen kind of maybe right here in this rally. You see a little bit of a pullback and then it rallied up. There was a pullback and it started to stumble. You see that pullback starting to stumble here. It did make new all-time highs before there was a massive reversal. We could be setting up to see something similar here. The concern I have is when we zoom out to the weekly chart, what you see is the RSI trending down. It's slowing. Momentum is coming down slowly, though, not quickly, but still you're seeing everybody pile into the broad equity market here at a time momentum is slowing down. But we also look at machine positioning. We talked about how the machines are levered in going longer. Well, we run a fast algorithm and a slow algorithm on our machine positioning, and here's the best part: we show our subscribers how to make money trading machines, how to make money trading momentum in a way that they've never had before. We make it so easy, and we put the probabilities in your favor. Here's how we do it. It's easy to use. Over 2 hours before market opens, we publish our reports and our opinions on them. That's right, I give you my view on every trade. All you have to do is place a buy with open trade and then later put on a stop loss. You can go about your life. You don't have to watch screens. You don't have to watch your phone. And you just update your stop losses once a week, and then you cash in and watch the money roll in. You get the daily reports. You get either one you want: CTA, Momentum Timer Pro, or even both. Tradable signals. Again, my opinion. We did a back test on CTA to validate that our report is as good as we say. We give you the stop loss levels, we track the trades for you, and we update our stop loss levels each and every week. And unlike everybody else out there, our returns are 100% duplicatable. That, and we give you a 30-day free trial. No one else does it because they know you won't make money. They want to get your money up front. We don't. We want you to make money up front. Let's talk about the NASDAQ here as we shift over to the QQQ. Relative strength index sitting at 59. Momentum here positive. MACD's got a positive cross. We've got 7 daily consecutive buy signals on our Momentum Timer Pro. You notice we don't have a position because we don't want to be trading into this blackout window. We're really concerned about the risk here, and there's certain times when you want to take risk and certain times you don't, particularly when there's other sectors where you see opportunities show up. B of A has mentioned 2 of them. That's right, the bond market and commodity market, and our subscribers are all over the opportunity in the commodity space. I'm going to show you one of those trades later and why you want to jump on that. Again, links to our reports are in the description below. Get that 30-day free trial, because unlike the S&P, which is sitting right at all-time highs, we notice our machine positioning on the NASDAQ starting to pull back here. You see coming off that 100% position. Even though momentum is there, what the risk is this market is overcooked in a big way. Let's take a look at QQQ, because you see it again, huge run up without any downturn in the NASDAQ. Let's zoom out to the 2-year chart. But here's the problem. While the S&P is sitting right at new all-time highs, the NASDAQ can't get there, even with all the massive repurchase of its shares from the biggest players of tech. And we're going to be looking again to see what they're going to tell their customers here when they report earnings. Are they going to continue to buy back stocks at the current pace? If they can't, watch for the market to go down, because this is really what's underpinning everything, is companies buying their stock back. Let's talk about small caps, which looked like they were going to head down 6 days ago. Boy, they flipped and reversed. It hit our upside target. We really slightly revised our downside target up, but once again, you see machine positioning long here. We lead the head of course, the actual machine positioning, because you know what we do different? We run a historical overlay. So we actually know when machines are offsides and not. We actually know, and that gives us the advantage. One of the reasons why we have such a strong hit rate and success rate on our reports. You too can make money trading. Links again in the description below. But look at momentum. It's not as high, not as strong over the 1, 3, and 6 month period as we see with, of course, this S&P and the NASDAQ. But let's take a look at IWM here. And what we see here is a shot up into the supply zone, pulled down to the 200-day moving average, traded up, really didn't get back to that recent high, pulled back into the supply zone again, then shot straight up on the hopes that perhaps a rate cut is going to be bullish for small companies, when in turn it usually isn't, because small companies here are hurting in a big way. You'll notice from a zoomed out view, this looks like a big bottoming pattern about to take off, but here's the key. It's got to break out over 232. This is where a lot of people have been selling small caps. If it can't break out here and it reverses, this bottoming pattern is negated, and then you're looking at a pullback down in here to this 174 level, not off the table here as we look towards the election, where we typically see stocks sell off before the end of the year. But let's talk about the banking sector, because many people believe rate cuts are bullish for banks, and they just don't understand how the financial system works, because when rates go down, well, that means financial conditions are tightening. Banks are actually lending less in that case. Not bullish for them at all. They want higher rates, but the market says we buy into this, and 6 consecutive daily buy signals. Momentum turned up after a sell signal, but look at this. That 1 month window is maxed out. Now, once again, we made money trading this, but we got out, we got stopped out, and for good reason. Too much risk here, potentially facing what could be another crash in the banking sector. Again, not able to get up to those recent highs, continues to get stuck right at this current price level. This is a potential double top forming. If this reverses, watch out. It's head right back down to this roughly 45.97 level. You see that red line? That is where the volume profiles turned on over the last 5 years. That is support where the most shares have been traded at any point over the last 5 years. We see buyers sitting there. Will they continue to buy? That is the question. Will the banks be able to continue buying their stock back at the current pace? We'll find out soon enough, because now let's turn to emerging markets. We see 4 consecutive daily buy signals. That is not sell signals. A little bit of a typo here. Momentum is indeed positive. It did hit our upside target. Perhaps we're going to see some sell signals. Maybe that is some foreshadowing going on there, but I'm largely sure it's just a typo. And when we zoom out, what do we see? Emerging markets really not following the big companies higher here. Let's zoom into the 1 year window. And what do we see? It sort of runs right out of steam exactly where it's at. You had what looked like a left shoulder ahead, a right shoulder. It broke down and then found massive amount of support, and that still isn't enough. Maybe this is the neckline right here around 41.55. We'll see if that's true. If it gets rejected here, look for again for the sellers to dominate, push down. Support comes right around the 200-day moving average and then down over this last 1 year. You're looking at the volume profile, 39.50. That is the target. Momentum, again, it's pushed higher, but can it hold? Or are we about to see the markets roll over here? Because there is one place the B of A is bullish on. That's the bond market. Let's talk about over the next week, because we look at the Goldman data here. They're skewed to the downside. As in a flat tape, there are buyers. In an up tape, there are buyers. But in a down tape, we see 25.85 billion of global equities to sell. Only 4.3 billion out of the U.S. But here's the big one. In a down tape, 357 billion in global bonds, 130 billion out of the U.S. You want to see bond prices go down and rates go up over the next month. The CTAs here could be the driver of that. The question is there enough buying support? We'll find out soon enough. But let's take a look, because one thing we do know is that bond prices tend to rally coming out of an election. Interest rates tend to fall. It doesn't matter who's usually elected. Probability suggests rates are coming down here. But let's take a look at TLT. We've got 1 consecutive daily sell signal. The MACD is still above 40, but broadly speaking, when we run a proprietary overlay, what we see is selling pressure here, and we see the upside target almost got hit. But how about this? We didn't trade those with stop loss. Now, mind you, we tell people they should do that. We're still up 5.19% as of Friday's close. And again, all we did was use the tools on our report. We got that behind on that trade. Some of you remember, he said, no, there's no way that trade will ever turn positive. And I said, look, just dollar cost average in, use the reports. When the signals turn positive, follow them and buy, just add to your position. And now look, we're up on that trade. Now has plenty of upside potential. B of A is right. If you see a hard landing, interest rates are coming down in a big way. They also said gold is likely to go up. Momentum is positive. 31 consecutive daily buy signals, sitting right at its all-time highs. This thing's got bullish positioning across momentum and across machine positioning. Here's my question. I don't know how high gold goes, but I'd love to know from you. Do you have a price target on gold where you might be selling? Put the number in the description below. I'd love to hear from you, because while gold's going higher, gold miners aren't. We see the momentum is positive. Everybody's hoping the miners follow the metal, but they just don't have the momentum strong enough to push price to all-time highs. I know many people would love to see this, but the RSI, the MACD, confirming what Momentum Timer Pro is saying, 7 consecutive daily buy signals here. We don't have position on this. It almost hit our upside target, downside target, 36.33. See machine position here stretched out to the long side, pretty much like this entire market. Everybody's long this market. But what do you see here? This orange dotted line was support. Price pulled into here, held, took off, pulled back to the 100-day moving average, took off, pulled back underneath the 50-day and took off. Here's the problem. And we zoom out to the 10-year chart, investors want this thing breaking out over 45. It's not there. Can it keep climbing this wall one step at a time, or is it about to reverse? There's nothing convincing here that shows either way on gold miners, but for now the trend is to the upside. Momentum looking to push up before we see another short-term top here. Where it goes from there, well, that's anybody's guess. Let's take a look now at the dollar before we get to the commodity space. Dollar's got 15 consecutive daily buy signals, but we're bearish on the dollar. And then why is that? Because the market says when the Fed cuts, it weakens the currency. That means we have to be bearish on the dollar. Let's take a look at a dollar chart here, see what we find, because UUP looking like it's headed a whole lot lower. That could be a big boost for gold, because when we look at the 1-year chart, it's sitting right under that 1-year volume profile. There's a bottom here. Buyers came in again at the same level. We told our subscribers when it tripped our signals, don't buy this one. The 200-day moving average is resistance. Right now, the resistance 28.26. You're looking at a big drop in the dollar. That could be the tailwind that everyone's looking for in the equity market and in the commodity market. We'll see. I think there's way more upside in the commodity market. Let's talk about why as we shift over to soybeans, which, as you know, we've been featuring on the show. I've been telling people this is one of those great signals. In fact, on August 27th, we put a buy it open on both of our reports. It flagged that trades up 2.45%. You say, well, that's not that much. I said, well, wait till you see the upside potential here. 19 consecutive daily buy signals. Here's our live stop loss level that we give to our subscribers. Upside target, short term 22.56, but this thing could take off. And the news behind the grains and soybeans and all the sorts of other soft commodities are telling us there's upside potentials. The machines pulled back here a bit recently, remain long on the fast algorithm. We see on momentum still pushing higher, but let's take a look at the chart here, because what we see in soybeans is upside potential. Here we have soybean chart. Look at this. Let's zoom out. Let me show you why. People want to buy things at all-time highs. How about buying things that have a big pullback? You want to see opportunity? Well, the opportunity is that it could break up here to this 24.50 level. That would be the 200-day moving average. Right now, it's running into trouble at its 50-day moving average, but if it can break through that crossover and push to the upside, you'll notice underneath that is the 21-day moving average. If that crosses through the 50-day, that's usually a positive indicator. If price can hold over the 50-day and turn up, look for a move up here to 24.50. That could be a huge return that you'll see why everyone's chasing the equity market higher. Commodities, bond market could be where it's at based on what Bank of America is saying. Based on what we see in the charts, it tells us there are far lower risk trades than U.S. equities right now. And right now, it could be soybeans, could be other commodities. You have to find out. Check our reports. We tell you where to go each and every day. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.